Welcome, investors. Fed Chief Jerome Powell is grilled by Congress. He says they still need to see more to have confidence that inflation is actually coming down. And with the hot jobs numbers, there's something that we need to fundamentally understand as investors so we can make the best investments decisions. We're going to go through those and get you on the right path to making wise investment choices because you're going to understand the data, understand what you're reading, understand the timeline of this data. So let's get right into it. So first thing we're going to do is we're going to start with the key takeaways from the congressional hearing with Fed Chief Jerome Powell. All right, so our first key takeaway. Powell said the Fed needs more confidence on inflation before they cut rates. Powell said the Fed only needs a little bit more data before it decides to move on rates. Powell said he expects major changes to the proposals that bank hold more capital. He left the door open on starting the whole process over again. And this is good news. We don't want the banks to have to overcapitalize. That means they won't lend to consumers. They won't lend to businesses. Powell said he didn't think the U.S. is headed towards a recession given the state of the economy and labor markets. We're going to get into understanding what that means, economy and labor markets and the current data. So we'll get in a little bit more about that data that he's citing and what is he using to say, hey, we don't think a recession is coming because we're seeing this certain data that we're going to highlight and make our decisions on right now. But that'll be later in the video. I want to go through some more data that we've seen this week, and we're going to talk about each one and what it means. This really the important ones. There's always lots of data released every single day. A lot of it's not necessarily useful for us, so we try to highlight the ones that are the big market movers and really give us a forecast of what happened in the future or the current state of the economy. So let's go through this data. All right, so I have this trading economics calendar here, which just shows data, and this column is the actual data, and then this column right here is the consensus of the forecasters and economists. So we'll start with this ISM, which is the product or the economic activity in the manufacturing center. Expectation was 53. We got 52.6, so less below expectations on the manufacturing data. We have the ADP employment change, which is private sector payroll. Expectations 150,000. We get 140,000, so below expectations, showing signs of weakness. Initial jobless claims, that means people filing for unemployment. Expectations was 215,000. We had 217,000, so a little bit above expectation, showing more weakness. And now let's get into today's data, Friday. Non-farm payroll, 200,000. Expectations 275,000. This one's interesting. Unemployment rate 3.7, but it ticked up to 3.9. So more jobs, more unemployment rate. Not so sure about that. Average hourly earnings 0.1%, which is lower than inflation. Let me show you this. Let's slide up here. We're going to take a look at PCE, which is inflation data. Where is it? Okay, right here. And inflation data is right here. Look at this, 0.3. So that means our wage increases are not keeping up with inflation. You're losing the purchasing power of your dollar. I want to touch on this non-farm payroll. Initial U.S. employment reports overstated by 439,000 jobs in 2023. 8.7 million Americans, a record high, hold multiple jobs to make ends meet. The government quietly erased 439,000 jobs through November 2023. A close look at the Bureau of Labor Statistics. That means the initial job results were inflated by 439,000, and the job market is not as healthy as the government suggests. So that's why I have a problem with the non-farm payroll report, especially when we look back at 2023. It was nearly every single month, except for maybe December, and there might have been one other month. Don't quote me on that. Every month, the non-farm payroll, like today, you see 270,000. Well, months later, they would come and revise that down. So the initial expectation, the initial reaction was everything's good, the things are strong right now. And then come to find out 2-3 months later, they're starting to lower the jobs numbers. There's actually almost 500,000 jobs that weren't created, and they stated they were created in 2023. So that's a problem with their data calculation. That's something that's not reliable for us to look at. And what is non-farm payroll? It's the numbers of jobs created in a month, or new jobs. As I stated at the beginning of the video, we need to understand, what data are we looking at? You have the analysts, the economists, Politicians, economists, Fed officials, they're citing data right now telling us that recession isn't likely, everything's good. What data are they citing? We need to understand this. This is very important that we understand what the data that they're using. The data that they're using is not foreshadowing what's going to happen in the future. I'm going to share a really useful article that I found by Investopedia that gives us a breakdown on us understanding what kind of data we're looking at. And before I go into any more, I'm just going to share the article with you because it's written quite well and it'll help us all understand. So we need to understand leading, lagging, and coincidental indicators when we're reading data. All right? So what are indicators? An indicator can be any statistic that is used to predict and understand financial or economic trends. So let's scroll down here. Leading indicators. A leading indicator is a measure of set of data that might help to anticipate trends and forecast future economic activity, such as the yield curve that I talk about every darn video now. These lines that plot yields, interest rates, of bonds with equal credit quality but different maturity dates are viewed as a key indicator of the direction of the economy. Let me show you an example. So we have the 3-year Treasury versus the 10-year. So when the 3-year yields higher than the 10-year, you get an inverted yield curve. That's that zero line. And what happens after an inverted yield curve? Let's take a look. In the shaded areas are recessions. Boom, we get an inverted yield curve and recession. When it de-inverts. Let's keep going here into 2000, inverted yield curve and recession. All right, let's fast forward to here, 08, 09, and inverted yield curve and recession. And again here in 2019, 2020, and recession. Here's where we are today. We're deeply inverted. We have not come out of this inversion yet. Next leading indicator, new housing starts. If housing starts rise, it means builders are optimistic about the demand of the near future for newly constructed homes. If housing starts fall, builders are cautious. Let's look at new housing starts under construction. So that means there's going to be added inventory in the future. What happens when we get a whole bunch of new inventory and the new housing constructions fall? We get a recession. Again, we get a big upswing and then we follow by a recession on the decline. Again, further decline in the later 80s, recession. This one we just seen kind of a trending down here into the early 90s. Early 90s was a very mild recession. We did have a small one. And in the dot-com bubble, this recession was mostly due to stocks, Enron, bad malinvestments. 2008, 2009, decline starting in 2006, and then recession. 2020, that was a blimp in the radar, but here we are now. Are we about to start seeing a decline? I think we'll know in the next few months. Purchasing Managers Index, that's that PMI, that's that manufacturing, that shows the economic activity in the manufacturing center. Let's take a quick look. Yeah, we don't need that. Perfect. All right. So you'll see below this, well, let me see if I can zoom up here for you guys. There's that 50, that right in that middle mark. When it starts to tick below this 50 reading, we see weakening economic activity, recession there. No recession there, it was weakening. 2000, 2001 recession, 08, 09 recession. 2020 recession, and here we are. We're below 50. Will we get a recession? Just flashing warning. The overall money supply, the money supply in the economy, in your banks, your consumers' pockets. Here's a chart of the money supply. For all of American history, it has gone up but 2 times. One during the Great Depression and one right now. It's the first time it's retracted since the Great Depression. Now, granted, in 2020, we did have a huge injection of money. So all those indicators and data points that we just looked at are helpful and useful, not solely by themselves, but a conglomerate of different data points that are leading, showing what potentially might happen in the future. Doesn't mean it's always right. It just gives us a higher probability. Nothing's guaranteed with our investments. All we can ever do is put the highest probability on our side, and that's how we come out on top consistently over and over again. We're not always going to win, but we can come out consistently on top when the odds are in our favor. So that's what we're doing with these leading indicators. We're looking into what potentially happens in the future, and that's how we can make useful investment choices right now, today, because we look at things in the future. Okay, now let's look at another data point, the lagging indicators. Put this article back up on your screen here. So lagging indicators can only be known after the event, but that doesn't make them useless. They can just clarify and confirm a pattern that is occurring over time. So think the unemployment rate. Once it starts going up, it confirms the downturn. Think consumer price index. Think about 2021 when they said everything was transitory. Well, eventually the CPI confirmed what everyone was feeling at the grocery store, at the pump, and everything that we purchased. And the last indicators that I want to talk about and what the Fed officials are using is the coincidental indicators. Coincidental indicators are statistical indicators that use change simultaneously with general economic condition, and as a result, are viewed as reflecting the current state of the economy. Think your personal income, your gross domestic product, which shows you what's happening right now. And then, think of your consumer spending. That's consenting. That's happening right now. Think of retail sales. That's the numbers that companies issue to show how much consumers purchased. So what's happening right now? You have your Fed officials, your analysts, a lot of your economists. They are using coincidental indicators saying what's going to happen in the future with this recession. Hey, the jobs numbers are good. Unemployment numbers are great. There's no way we're going to have a recession. Those numbers are always good until we have one. So what can we look at to give us an accurate picture in the future? We have to look at leading indicators. We use coincidental indicators to tell us what's going on right now. So when things are getting nasty, we can look at coincidental indicators. And we can also look at coincidental indicators to tell us things are still good, which is what's happening right now. And then we use lagging indicators to tell us, that confirm our thesis on things. So when unemployment rate starts to go up, that means that things are already nasty, things are already bad because companies had to lay off because consumers weren't spending. Simple as that, folks. Hey folks, if you're finding value from this, do yourself a favor, click that like button, subscribe to our channel so you can stay ahead of the curve. All right, well, stay tuned with us. We have some more data we'll talk about next week, some other big events that are going to take place, and we'll cover them for you. Expertise you deserve, experience you can count on.